Every headline hides a money trail. I'm Mr. D. Let's follow the money. America's biggest home builder just lost half its earnings. The Fed says no rate cuts, and home sales just hit a 30-year low. Raj Patel is 37, software engineer in Tampa. His wife Priya teaches third grade. Together they make $165. That's above the national median. 2 kids, 3-bedroom rental, $2,400 a month. They've been saving for a house 3 years, $1,200 a month into the fund, $58,000 in the bank. Last year, Raj found a place, 4 bedrooms, good school district, listed at 4.2%. The monthly payment would be $2,850 tight, but the math worked. He checked again last week. Price dropped to $385. Builders are slashing prices. Inventory is piling up. He should be celebrating. He's not, because while that house got cheaper, everything else got more expensive. Gas up 40%, groceries up 18%. Priya's health insurance premium jumped $200 a month, and the mortgage rate still 7.2%. The Fed was supposed to cut rates this year. They can't. I'll explain why in a moment. Raj is watching the housing market crack, and he can't afford to catch the falling pieces. And the chain that brought him here doesn't start where you think it does. Something strange is happening right now, and nobody is connecting the dots. This week, Lennar, America's second largest home builder, reported earnings. The numbers were brutal. Revenue, down 13%. Operating earnings, cut in half, down 54%. Their stock collapsed 52% since September 2024. But here's the number that stopped me cold. Lennar's average selling price has fallen back to 2017 levels. The second biggest home builder in America is selling houses at prices they charged 9 years ago. Not because they want to, because they have to. Existing home sales, 30-year lows. Builder confidence, lowest since 2022. And yet your neighbor's Zillow estimate still shows $450,000. Why? Why is the biggest builder slashing prices while the market pretends everything is fine? Because 3 forces hit housing at the exact same time this week. Nobody is talking about how they connect. And here's the thing. Think about a castle. Thick walls, deep moat. It can take a hit from one direction, maybe 2. But when enemies hit from 3 sides at once, the walls don't hold. That's your housing market right now. Front one, the mortgage wall, the average 30-year mortgage is above 7%. Raj's parents bought their house in 1998 at 6.7%. Their rate was lower than his, and their house cost a third of today's prices at 7%. A $400,000 house cost you $2,660 a month. Add property taxes, insurance, maintenance, you're at $3,200 to $3,500. That's 40% of take-home pay for a family making $165. The old rule was 28%. We blew past that years ago. Everyone assumed the Fed would cut rates this year, but the Fed has a problem. Front 2, inflation came back. Core PCE, the Fed's preferred inflation measure, just hit 3.1%. Worst reading in 2 years, not going down, going up. Why? Oil. Brent crude closed above $100 for the second straight session. The Iran war has removed 3 to 4 million barrels a day from the global supply. That's not a blip. That's a hole. When oil goes up, everything goes up. Shipping, heating, anything made with petrochemicals. And that's just inflation. The supply side is even worse. Front 3, construction costs. Diesel, the fuel that runs every excavator, every crane, every truck on a job site, is up 40% since the Iran war started. Asphalt is petroleum. PVC pipe is petroleum. The insulation in your walls is petroleum. Builders can't raise prices because nobody can afford 7% mortgages. And they can't cut costs because oil at $100 is making materials more expensive. Revenue down 13%, earnings down 54%, stock down 52%. That's not a correction. That's a siege. But here's what I haven't told you yet. We've seen this before. Okay, so this is where most people stop the story. They say housing is correcting, but the chain goes deeper. Imagine a poker game. First few rounds, everyone plays careful, small bets, smart folds. But one player starts winning, then another. Pretty soon, everybody's pushing bigger stacks into the middle. They borrow chips. They convince themselves they can't lose. Then someone flips a bad card, and all that leverage comes crashing down at once. Economists call that moment a Minsky Moment, named after Hyman Minsky. His whole career proved one idea: stability creates instability. The longer things go well, the more risk people take, until one shock breaks everything. For housing, the good times ran from 2012 to 2024. 12 years. Prices went one direction, up. Builders borrowed to build more. Investors bought entire neighborhoods. Families stretched to buy before prices climbed higher. Housing only goes up became the unquestioned truth. The NAHB index, builder confidence, is at its lowest since 2022, lower than during COVID. The people whose entire business is building homes are telling you something is wrong. Lennar's 54% earnings plunge isn't a one-off. It's the first crack in the dam. Now, if you're 38 and you bought a house in 2021, maybe you locked in at 3%, congratulations, you're trapped. You can't sell because selling means giving up 3% and buying at 7%. You can't move for a job. The math doesn't work. 30 million American homeowners are in this exact position. And if you're Raj, a renter trying to buy, the window is opening on price, but the Fed is nailing it shut on rates. The house got cheaper. The payment didn't. Here's where the history gets uncomfortable. In 2006, homebuilder stocks peaked. Lennar, D.R. Horton, Toll Brothers, their share prices started falling in mid-2006. Wall Street noticed, most people didn't, because house prices kept going up for another 18 months. It wasn't until early 2008 that prices followed. By then, the whole system was unraveling. The lesson, builders see it first. They see cancellations rising, foot traffic dropping at model homes, buyers walking away from contracts. They know months, sometimes years, before the charts catch up. Lennar was one of the first to crack in 2006 too. Their stock dropped 60% before the average home lost $1. They're doing it again. Now, before you panic, let me be honest. This is not 2008. In 2008, the crisis was fraud, subprime mortgages, ninja loans, no income, no job, no assets, banks bundling garbage and selling it as gold. The foundation was rotten. Today, lending standards are tighter. Borrowers have better credit. There's no subprime bomb. So it's fine, right? Not exactly. Because what we have instead might be worse for your family. In 2008, the problem was bad debt. In 2026, the problem is stagflation, rising prices, and a shrinking economy at the same time. The economy just lost 92,000 jobs last month. First negative print since the pandemic. Inflation rising, oil rising, and the Fed can't fix any of it because every tool makes one of the other problems worse. Cut rates, inflation spirals, hold rates, economy contracts, raise rates, financial crisis. In 2008, the Fed had tools. They cut to zero. They printed money. They bailed out banks. This time, those tools are locked in a box marked would make things worse. And here's the part that got me. Look at what the smart money's doing right now. Goldman Sachs is pitching hedge funds on strategies to short corporate loans. The same Goldman Sachs that in 2007 built the famous Big Short, betting against subprime while selling it to clients. Private credit, a $1.7 trillion market, is cracking. Boaz Weinstein warned this week that private credit is infecting public markets. BlackRock has already gated redemptions from some funds. When BlackRock tells investors you can't have your money back, pay attention. Institutional investors are pulling out of Sunbelt real estate. Phoenix, Tampa, Austin, Dallas, the exact markets that boomed hardest in 2020 to 2023. The exact market where Raj lives. Connect the chain. Iran war. Oil above $100. Construction costs spike. Inflation reignites. Fed can't cut rates. Mortgage rates stuck at 7%. Buyers can't afford homes. Builders / prices, earnings collapse. Builder stocks crash. Credit stress builds. Smart money exits. And at the end of that chain, your home equity, your 401k, which holds REITs and mortgage-backed securities you've probably never looked at, your neighborhood's property tax base, which funds your kid's school. So what does this mean for you? Let me be specific. If you own a home, your equity is not as safe as Zillow says. Zillow estimates are backward-looking. In overbuilt Sunbelt markets, Phoenix, Tampa, Austin, prices are already softening. If you bought after 2020 at peak prices, your paper gains may evaporate over the next 12 to 18 months. Don't panic sell, but stop counting on that equity for your retirement math. If you're renting and want to buy, look, this is the most confusing moment in housing history. Prices coming down, rates not. The monthly payment, the thing your bank account actually feels, hasn't changed. If you've got a stable job, solid savings, and you're staying 7+ years, the falling prices are real. But don't try to time the bottom. Nobody can. If you've got a 401k, check your exposure. Many target date funds hold REITs and mortgage-backed securities. If builder stocks are the canary, your retirement portfolio might have a canary in it you don't know about. The deciding question, the one that determines whether Raj buys that house, is this: does the Fed fight inflation or save housing? If they fight inflation, rates stay high, housing stays frozen, builders bleed, prices fall further, Raj might get his house in 18 months at a lower price. After the siege breaks, something big enough to force the Fed's hand, if they save housing, they cut rates, inflation rebounds, oil goes higher, your grocery bill jumps another 15%, the dollar weakens, Raj gets a cheaper mortgage, but his buying power erodes. There is no good option. Every move makes something worse. Raj checks Zillow every night after the kids go to sleep. The house, 4 bedrooms, good school district, just dropped to $379,000. 6 months ago, it was $420,000. He runs the numbers again. At 7.2%, the monthly payment on $379 is $2,570. Add taxes, insurance, maintenance, $3,100. That's $700 more than his rent every month for 30 years. He closes the laptop. Priya asks from the hallway, "Did the price go down again?" "Yeah," he says. "It did. So, is that good?" He doesn't answer, because the honest answer is he doesn't know. The house is cheaper. Everything else is more expensive. The siege hasn't lifted. The Fed meets next Tuesday. And the biggest home builder in America just told the world through its earnings, through its slashed prices, through its 52% stock collapse, that something is very, very wrong. The builders see it first. They always do. The question is whether you're paying attention. I'm Mr. D. If this helped you see what's coming, subscribe so you don't miss what comes next. Follow the money. I'll see you next time.